What is an annual percentage rate, APR? The term yearly percentage rate, APR, relates to the yearly rate of interest charged to borrowers and paid to investors. APR is expressed as a percentage that represents the actual annual cost of funds within the term of a loan or income earned on an investment, including any fees or additional costs associated with the transaction. However, it doesn't take compounding into account. The APR provides consumers with a bottom-line number they may easily compare with prices from other creditors. 1. How annual percentage rate, APR, works. An yearly percentage rate is expressed as an interest rate. It calculates what percent of the principal you'll pay every year by taking things like monthly installments into account. APR is also the yearly rate of interest paid on investments without accounting for the compounding of interest within that year. The Truth in Lending Act, TILA, of 1968 mandated that lenders disclose the APR they charge to borrowers. Credit card suppliers are allowed to advertise rates of interest on a monthly basis, but they need to clearly report the APR to customers before they sign an agreement. 2. What's APR calculated? The speed is calculated by multiplying the periodic interest rate from the number of periods per year wherein the periodic rate is applied. It doesn't indicate how oftentimes the speed is applied to the balance. APR in the US is typically presented as the periodic interest rate multiplied by the number of compounding periods annually. Definitions of APR outside the United States can be quite different. The European Union, EU, focuses on consumer rights and financial transparency in defining this term. A single method for calculating interest rate was created for many EU member nations, though human nations have some leeway over determining the exact situations wherein this formula is to be adopted above and beyond EU stipulated cases. Types of APRs. Charge card APRs vary based on the charge. A lender may charge one APR for purchases, another for cash advances, and yet another for balance transfers from another card. Banks also charge high-rate penalty APRs to customers for late payments or exceeding other terms of the cardholder agreement. There's also the introductory APR, a low or 0% APR that many credit card companies use to entice new customers to sign up for a card. 3. The APR debtors are billed additionally as dependent upon their credit. Loans provided to those with excellent credit carry significantly lower rates of interest than the prices charged to those with bad credit. 4. Loans usually come with either fixed or variable APRs. A fixed APR loan has an interest rate that is guaranteed never to change throughout the life of the loan or credit facility. A variable APR loan has an interest rate that might change at any moment.